Hey everyone, welcome to our channel. We're talking about two things that are probably impacting your wallet right now. Inflation and interest rates. They sound kind of boring, but trust me, they directly affect how much money you keep in your pocket at the end of the day. We're gonna break it all down, super simple, so you can make smart decisions with your money. Whether you're trying to buy a house, finally pay off that credit card debt, or just grow your savings, this video is going to give you some actionable steps you can take right now. No more freaking out about the news headlines. Let's get you in control of your finances. Inflation and interest rates are two major forces that shape the global economy and have a direct impact on our personal finances. Whether you're buying a house, managing debt, or trying to grow your savings, understanding how these two factors interact can help you make better financial decisions, no matter the economic climate. Let's start with inflation. Simply put, inflation is the rate at which the prices of goods and services rise over time. When inflation goes up, your money buys less, which means the cost of living increases. You'll notice it at the grocery store, when filling up at the gas station, or even with rent and utility bills. But inflation isn't always a bad thing. A little inflation can be a sign of a growing economy, but when it gets too high, it can erode the value of your savings and make everything from groceries to housing more expensive. So, how do interest rates fit into this? Central banks, like the Federal Reserve or the European Central Bank, use interest rates to control inflation. When inflation is too high, they raise interest rates to slow down spending and borrowing, which helps bring prices back under control. On the flip side, when interest rates go up, borrowing becomes more expensive. That means higher mortgage payments, car loans, and credit card interest. However, if you're a saver, higher rates mean better returns on your savings and investments in things like bonds. The relationship between inflation and interest rates has a direct impact on your personal finances. If inflation is high, but interest rates remain low, your savings lose value because prices are rising faster than your money grows. But when interest rates rise to control inflation, borrowing becomes expensive. So, what can you do? In times of high inflation and rising interest rates, it's all about making strategic decisions with your money. Alright, let's talk debt. Nobody likes it, but most of us have it. Minimize the damage high interest rates can do to your finances. Credit card debt is public enemy number one. Those interest rates are brutal and rising. Attack those balances aggressively. Cut back on unnecessary spending and throw every extra dollar at that debt. There's no better feeling than being credit card debt-free. Next up, mortgages. If you have an adjustable rate mortgage, pay close attention. As interest rates increase, so will your monthly payments. Consider refinancing to a fixed rate mortgage. Locking in a lower rate now could save you thousands. Don't be afraid to negotiate with lenders. Be your own advocate and fight for the best possible rate. Bottom line, get that debt under control. It's the best thing you can do for your financial health. Okay, enough with the doom and gloom of debt. Let's talk about something positive. Higher savings rates. Rising interest rates can work in your favor. Banks pay more to keep your money with them. It's like they're competing for your business. Ditch low-interest accounts. Use high-yield savings accounts instead. They offer higher interest rates, and they're FDIC insured. It's a no-brainer, people. Rebalance your investment portfolio. Let's talk about your investment portfolio. Now, I'm not talking about picking individual stocks or trying to time the market. That's a recipe for disaster. But it's important to be aware of how interest rate hikes can affect your investments, especially if you're invested in the stock market. See, when interest rates rise, it can create some volatility in the market. Growth companies, especially those that rely on borrowing money to fuel their expansion, might feel the pinch as their borrowing costs increase. This can lead to some ups and downs in the stock market. That's why it's crucial to have a well-diversified portfolio. Don't put all your eggs in one basket, as they say. Instead, spread your investments across different asset classes, like stocks, bonds, and real estate. Now you might be thinking, Graham, you just told me to look into bonds. Are those not affected by interest rates too? You're right, they are. But here's the thing. When interest rates rise, the prices of existing bonds typically fall. Why? Because investors can now buy newly issued bonds with higher interest rates. It's all about supply and demand. But this isn't necessarily a bad thing. If you're investing for the long term, those price fluctuations shouldn't scare you. In fact, it might even present a buying opportunity. And remember those dividend-paying stocks we talked about earlier? They can be a good option in a rising interest rate environment. Companies that pay dividends tend to be more established and less sensitive to interest rate changes. Plus, those dividend payments can provide a steady stream of income. The key takeaway here is to review your portfolio regularly and make sure it's still aligned with your financial goals and risk tolerance. If you're not sure where to start, don't hesitate to reach out to a financial advisor. Protect your savings from inflation. All right, let's talk about the elephant in the room. Inflation. It's the silent killer of your savings, slowly but surely eroding the purchasing power of your hard-earned money. Think about it this way. If you had $100 today, you could buy a certain amount of goods and services. But fast forward a year or two, and that same $100 might not get you as much. That's inflation at work. So, how do we protect ourselves from this insidious force? Well, one option is to invest in assets that tend to keep pace with inflation, like real estate. Now, I know what you're thinking. Graham, real estate is expensive. And you're right, it can be. But it doesn't have to be a $1 million mansion. You can start small with a rental property or even a REIT, which is like a mutual fund for real estate. Another option is to consider commodities, like gold or silver. These are tangible assets that have historically held their value during periods of inflation. However, it's important to note that commodity prices can be volatile, so it's essential to do your research and understand the risks involved. And finally, there's always the good old-fashioned Treasury inflation-protected securities, or TIPS. These are government bonds that are indexed to inflation, meaning their principal value adjusts upward as inflation rises. This can provide a hedge against inflation and help preserve your purchasing power. The bottom line is that inflation is a real threat to your savings, but it's not insurmountable. By investing wisely and diversifying your portfolio, you can protect your hard-earned money from the erosive effects of inflation. So there you have it. Inflation and interest rates. They're not as scary as they seem once you understand how they work. Remember, knowledge is power, and by staying informed and making smart financial decisions, you can navigate any economic climate. Whether it's tackling your debt, finding the best savings rates, rebalancing your investments, or protecting your money from inflation, there are always steps you can take to stay ahead of the curve. Don't let the fear of the unknown paralyze you. Take control of your finances. And remember, the best time to start was yesterday, but the second best time is right now. Understanding the relationship between inflation and interest rates is key to making informed financial decisions. Whether it's paying down debt, saving smarter, or adjusting your investment strategy, staying ahead of these economic trends can help you protect and grow your money in any environment. Don't forget to hit the subscribe button and stay tuned for more tips on managing your money wisely in uncertain times. How do you plan to manage inflation and interest rates? Let us know in the comments below.